Exercise number 2, direct material and direct labor variances. This question is very important questions and remarkable examples of real life when we create the variances report. And then for the purpose of studying, we want to apply the equations into that cases, right? So let's read the question first. Even though we already covered during the class, I realize many students are still being struggled with the figuring out that question because we have too much information on it in standard prices and quantity informations and actual price and quantity information there. Anyway, let's start by reading the question again. The Hill Fine Instruments manufactures trumpets and trombones, blah, blah, blah. During April, the Hill scheduled 550 trumpets. That is the schedule means the production, the budget, right? They expected how many the trumpets they will produce in expectation, in schedule, 550. However, the company produced only 525. Maybe there will be some reason. We want to see that variances, right? And then Hill purchased and used the 6 pounds per unit. That pounds can be also different from our budget in the data you see. And for direct materials at a unit price of $9 per pound, also that can be different, right? In comparing the actual budget, actuals and budget. It used 11 hours per unit for direct labor at an actual rate of 26 per hour. Okay, the following standard and actuals were developed for a line of trumpets. Okay, here you go. We have two tables to compare, right? Let's take a look at the standard price and quantity in terms of materials and labor and production. And the materials, the standard price per pound, that pound is $10 per pound, but the actual cost per pound is $9. That means you can already notice, oh, the actual price is low, then which is good. We purchase a lower price than our standard price expected, right? What about the actual quantity? Actual quantity per unit is 5 pounds, 5 pounds in standard budget, right? But in actual, we use 6 pounds more than that, right? So 6 times 9 per one trumpet, we spend 6 times 9, right? 54. But this one is the 50, right? Okay, let's take a look at the labors, the price and quantity variance from this information. The rate is $25 per hour, but 26 maybe we hire more kind of skillful the labor, right? And then even though we spend $26 per hour, they spend more time to produce the trumpet 11 hours. Maybe there will be some efficiency, the issues we can expect or imagine before actual calculation. Okay, and then the production, as we read the question already, 525. Maybe there will be some problem. Definitely from the variance in materials, and then the labor variance, right, from this the expectations. Okay, let's review one more time the questions, the equations. Price variance is calculated by actual price per unit. That unit is not the unit of trumpet. That unit is pound in this case. But the standard price, and then standard price per unit, also the pound, right? Not the unit, because we are going to multiple some actual production level here, right? Actual production here, and then we'll put the actual quantity used, to produce per unit, right? So this amount, this actual price per unit amount should be the pounds, right? Pounds. The quantity variance also calculated like that way. the actual quantity used for actual output minus actual quantity for actual output. That is total amount in quantity, because we will multiply the standard price per unit per 1 pound, right? Per pound, what is the price of 1 pound? So that quantity is including the total amount of quantity for 525 production. Okay, keeping in that mind, let's start the calculation, because we don't have standard quantity at the actual output level information. We only are given the price, right? And then the per unit hours, that's it. But we want to know the actual output level. At the actual level, what is the standard quantity in full, right? So that in full amount will apply this and this and this, right? So we should calculate intermediate process. So how to calculate? Right, 5 quantity 5 pounds per unit. And then what is the actual one? Okay, 525. That is the standard quantity at the actual output level. What about the labor? Where is the labor information? Right, labor information in terms of quantity. This is the rate, right? This one, right? And then the 10 times 525 actual outputs. That is the amount, right? And the standard quantity. That is 5,250 hours and 2,625 pounds. Okay, let's move on to actual quantity calculation process. So now, very easy, because we use 525 and we apply the standard quantity. But when you calculate the actual quantity, 525 times, now where is it? Where is it? We are calculating the actual quantity, 6. And then the same way, we are calculating actual quantity, right? In labor. So 11 times this. Then we got it, because we already are given this number. Let me just highlight this number, right? And then we have the rate. And then we have these two outcomes. Then we can calculate this equation. But before jumping into actual calculation, we want to know the flex of a direct cost variance in the big picture. What is the actual the direct cost variance, not dividing by the price variance and quantity variance? So we will use this equation: actual price per unit times actual quantity used for actual output level minus actual price, a standard price, that is budgeted price per unit, times the standard quantity for actual output. That is the difference in terms of direct cost variance, including the price variance and the material variance. But at the end of the day, you will see what is the specifically the variance in terms of price and variance later, right? And then let's calculate the direct material cost variance. How do you calculate? We use that equation. Where is actual? Okay, here we go. Actual 9 times actual material we used, right? And then minus, where is the standard price per unit? Standard price per unit. That unit again is not the trumpet. That unit is the pound, right? Here 10, and then times, what do we want to use? Right, we use this. We already calculate these materials. Let me see. This materials, 5 quantity times 525 actual production. So we come up with this variance. Okay. Then let's determine if this is favorable or unfavorable. And then maybe actual, because actual is greater than the standard, we spend more in the material cost. So this is unfavorable. What about labor cost? Labor cost also the same process when we answer that question. How do we calculate? Right, 26 actual rate per hour times, where is it? Right, that is the actual quantity used for actual hour labor in full amount of hours. And then it's the same way. What do we want to use? 25 times, okay, this number. Okay, we come up with 18,900 direct labor cost is also unfavorable because, again, actual price and quantity and the labor cost is greater than our expectation. We spend more in labor cost. And finally, let's jump into report 2. Now, it's not enough information in report 1, flexible budget direct cost variance, because it doesn't explain where went wrong. What went wrong in terms of price or quantity? That's why we want to figure out this one. And then in the price variance, we'll use this equation. So how do you calculate that variance? Right, 9 is, here you go, that is actual cost per pound minus, and then standard price per pound. Oh, now some of you guys already noticed the actual cost per pound is less than the standard price per pound, $10. That means, oh, they spend less amount, which is already favorable, because we are going to use the same actual quantity. Here it goes, actual quantity used for actual output level. That doesn't vary anything. We share this amount into standard price and actual price per unit, both, right? So minus 3,150. Oh, again, when we discussed in class, we do not use plus or negative sign in variance because it gets confusing. But we discussed about the sense of understanding. Okay, $9 is less than, actual spending is $9 per pound is less than 10. That means this is, right, favorable. So the variance doesn't create any negative or positive number. We want to see just the distance. Distance doesn't have any the negative or negative number. Always positive. But you should understand in the sense of favorable, unfavorable. We spend less amount in the cost per pound, $9, than the $10, the standard price. So that is favorable. Good. Now, let's calculate direct material quantity efficiency variance. Now, we have to use that equation. Got it? Okay, keeping that in mind, where do you get this information? Okay, you should use quantity we have calculated. Actual minus standard. Let's stop there a little bit because we want to know the favorable and unfavorable right away. We spend more, we used more pounds than our expectation, 2,625. So this is definitely unfavorable. Regardless of what amount we put next, standard price per unit is the dollar per unit we share into this variance. So where is that the amount? Here we go, $10 per pound we put there. So 5,250, this is unfavorable. We have favorable variance in the direct material price. We have unfavorable in the direct material quantity. Anyway, those amounts are the cost, the dollar amount. So we have to offset this amount to this, from bigger one to smaller one. So that is unfavorable, because unfavorable is bigger than the favorable amount in the price. So do you see, we have the same outcomes here and here, but we found what went wrong and what was good and what was bad. Right, the price variance, we spend less amount by 3,150, but we spend more in the material quantity, direct material quantity, $5,250 more than our expectation. So you should ask your employees who take this role, to take this responsibility or charge, that you can ask some feedback and give some feedback on it, right? Then let's move on to direct labor. Once we finish this work, and then let's speed up. Where is this actual price per unit in the direct labor? Here it goes, 26 minus 25 and times, what is the number do you put? Right, we should use actual quantity used for actual output level in labor. Here you go, this number. Now, we spend more rate when we hire the direct labor, $26 higher than our standard rate. So definitely this is unfavorable. What about direct labor quantity and efficiency, the variance? Now we use actual quantity used for actual output level in the direct labor quantity. Here you go. This minus 5,250, the standard quantity at the actual level of output, the full amount of output. And then times, we share the standard price per unit. That unit again is pounds. Where is that pound? The rate. I'm sorry, that is the rate. Where is that rate? 25. Here you go. So we got it. Let's sum up these two amounts because these two, sorry, let's come back. This two is unfavorable, so we can just sum these two, right? And then those results are unfavorable, which is the same as this unfavorable variance we calculated in a lump sum amount. Then they have two problems in price variance. They spend more money when they hire this direct labor, and they spend more time. Even though the reason why we hire the expensive one, because we believe they spend less time to produce, but they spend more time to produce one trumpet. So we so much inefficiency, right? So you should analyze like that way. Good? Okay, let's just stop here. And then those are the skills to understand the budget and the control of the budget. And then we want to analyze to give them what went wrong, what was good, and then to give this information to the next budget. And then you want to give some feedback to the person who are taking charge of this role. As a manager, I want you to practice this many times until this skill is get planted in your gut. Okay, see you next time.